The rent captive concept was introduced in Bermuda 20 years ago and remains a popular alternative market mechanism. Rent captive serve business that are unable to capitalize a captive but are willing to assume a portion of their own risk and share in the underwriting profits and investment income generally sponsored by insured or renewals which essentially rent out their capital for a fee. The mechanism allows user to obtain some of advantage of a captive without having the expense of setting up a single parent captive and meeting minimum capital and surplus requirements. Captive have been expanding into the employee benefits arena since 2003, the year in which the Department of Labor gave final approval to Archer Daniels Midland Copeland to use its Vermont captive to insure group life insurance benefits, while the leading domicile for captive in the US is Vermont. Offers show captive covering US risk are predominantly located in Bermuda, where they enjoy tax advantage and relative freedom from a regulation. The Cayman Islands, Guernsey, the British Virgin Islands, Luxembourg, and Barbados are also significant centers for captives. Vermont is the leading domicile for captives in the United States. Number two, self-insurance. Self-insurance can be undertaken by single companies wishing to retain risk or by in titles in similar industries or geographic locations that pool resources to insure each other risk. The use of higher retention deductibles is increasing in most lines of insurance. Inverse compensation. Many companies are opting to retain a larger portion of their exposure through policies with large deductible amounts of higher large deductible programs which were first introduction in 1989 new account for a sizable portion of the market. Number 3, risk retention groups. A risk retention group is a corporation owned and operated by its members. It must be corrected and licensed as a liability insurance company under the laws of at least one state. The group can then write insurance in all other states. It need not obtain a license in a state other than its charting states. Number 4, risk purchasing groups. Like risk retention groups, purchasing group must be made of persons or entities which like exposures and in a common business. However, where and RRG are liability insurance companies owned by their members. Purchasing group purchase liability coverage for their members from admitted insurance surplus lines carries of RRGS. Laws in some states prohibit insurance for giving groups formed to purchase insurance advantage over individual. However, purchasing groups are not subject to so-called fictions group laws, which require a group to have been in existence for a certain period of time or require a group to have a certain minimum number of members. The Risk Retention Act of 1986 specifically provides for purchasing groups to be created to purchase liability insurance for members of the sponsoring group. Catastrophe bonds. 5 other alternatives. Risk are products. A number of alternative risk transfer products such as uh, have developed to meet the financial risk transfer needs of business. One such protect. चलो यहीं पे कर लो. Number 5, catastrophe bonds and other alternate risk transfer ART products. A number of alternative risk transfer products such as insurance linked securities and weather derivatives have developed to meet the financial risk transfer needs of businesses. One such product, catastrophe bonds, risk-based securities sold by the capital market, developed in the wake of Francis Andrew A. Linky in 1992 and the Northern earthquake in 1994 mega catastrophe that resulted in a global shortage of reinsurance for such disasters. Tapping into the capital market allowed insurers to diversify their risk and expand the amount of insurance available in catastrophe-prone areas. Zurich Financial Camp Re was the first major catastrophe bond to be triggered. The 190 $100 million bond was triggered by 2005 Hurricane Katrina and resulted in a total loss of principal. Catastrophe bonds are now a multi-billion dollar industry. Catastrophe insurance issues. The term catastrophe in the property insurance industry denotes a natural or man-made disaster that is unusually severe. An event is designed a catastrophe by the industry when claims are expected to reach a certain dollar currently set as $25 million and more than a certain number of policyholders and insurance companies are affected. The magnitude of the damage caused by Katrina and the potential damage Hurricane Rita might have caused had it not weakened from an intense Category 5 hurricane has triggered an re-examination not just among insurers and reinsurers but also among public policy and political leaders of how the United States deals with the financial consequences of such massive property damage and personal loss. Disasters loss along the coast are likely to escalate in the coming years in part because of huge increase in development. One catastrophe modeling company predicts that catastrophe losses will double every decade or so due to growing residential and commercial density and more expensive buildings. Million people were seriously threatened by Atlantic hurricanes compared with 10.2 million in 1950 before the 205 hurricane season. Hurricane Andrew ranked as the single most costly U.S. natural disaster. Man-made catastrophes such as the attacks on the World Trade Center can also cause huge losses. The attacks led Congress to pass the Terrorism Risk Insurance Act in November 2002. Since then, TRIA has reauthorized twice. The latest reauthorization passed at the end of 2007 extends the law to 2014. TRIA provides a federal backstop for commercial insurance losses from terrorist acts, making it easier for insurers to calculate their maximum losses for such a catastrophe and thus to underwrite the coverage. See the topic on terrorism risk and insurance. The typical homeowner's insurance policy covers damage from a fire, windstorms, hail, riots, and explosions, as well as other types of loss such as theft and the cost of living elsewhere while the structure is being repaired or rebuilt after being damaged. Commercial property insurance policies generally cover the same causes of loss with some variation depending on the coverage selected. Flood and earthquake damage are excluded under home owners policies. Separate policies are available but are covered under a comprehensive portion of the standard auto policy, which more than 75% of drivers who buy auto liability insurance purchase the insurance